Welcome back. Wanted to take a little time and take a look at the 7-day review of overall markets. The orange bars over here show us the 7-day rate of change between various financial markets. The biggest moves to the upside include Litecoin as well as the NASDAQ 100 volatility index. That's the fear index associated with the NASDAQ. Now notice the VIX during the same period of time was up only about 2%, whereas the NASDAQ was up about 8% during that period of time. Oh, I'm sorry, not 8%, 15% during that period of time. The NASDAQ 100 index itself was down about 7%. And that is reflected here with the orange bars. The S&P 500 down about 7% during the last 7 trading days or so as well. Also stronger commodities we've seen lately, diesel, kerosene. So we're seeing a continuation in that correlation between stronger commodity markets and weaker equity prices. That's kind of interesting though, and we're going to take another look at a different chart to show us the difference between the NASDAQ volatility and the VIX S&P 500 volatility index, and to show you why there might be a difference in those two markets. First off though, quick recap of FX markets. Remember last week we spoke about the Thai baht being the highest, having a 62, almost 63 relative strength on the RSI index. The dollar's number 2, Israeli shekel 3. The euro and the Mexican peso follow that. The weakest one is a Turkish lira, followed up the list by the Swedish krona and Japanese yen. Now, with that said, if you recall last week, the Hong Kong dollar, see this orange bar to the downside, this red bar to the downside, it was by far our strongest currency last week. If you notice, the RSI on September 1st was 46. This is for the individual Hong Kong dollar. It then jumped on September 2nd to 64. It's back down to 43 now. Now, if you recall, there's a program within the city of Hong Kong where they're buying back Hong Kong dollars following the U.S. Federal Reserve in raising interest rates. Now, I'm not exactly sure why this reversed so quickly and so violently, but it's interesting to see how the trend didn't last very long, and that ultimately when there's a central bank that, or a city in this case, that makes a large macroeconomic fundamental move, we want to see a follow-through if we believe this trend to be persistent, to last a long time. It looks like, at least for the time being, the Hong Kong dollar is kind of reverse course, that maybe that was a one-off type of rally. Maybe it's the beginning of something more. But the second day, and we see it already retreat, I don't think that's a very good sign. Taking a quick look at the bond markets, top right-hand side, the red line shows us all the different bond yields put together. The 30-year bond, which currently is at the 349. Of course, we have an inverted bond yield curve where the 20-year pays a 374. The 10 years at a 333, and then we go all the way up to a 361 yield. That's on the 1 year. So now the red line continues to move higher as the blue line, S&P 500, continues to move lower. This is a very logical conclusion, or reflection of this, very simply because the stock market is weakening as a result of the expectation of higher interest rates. We're expecting interest rates to move higher because, again, inflation continues to rise. At least that's what the indications have been lately. In the center of the screen, we have the green line, which represents the spreads in between the bond pairs, meaning the spread between the 30-year and the 20-year is a negative 0.25% interest rate. Now, taking a look at the totality of this, we saw the spreads contract quite a bit, where the capital is really moving out of the bonds, or moving out, decreasing the difference between the bond yields, and that contraction indicates that the economy is shrinking. Obviously, it's moving down on the longer term bonds because there's fear out there, and the expectation is maybe over the long term we may see more gloomy market conditions. So traders are moving their capital into shorter bonds. Now, with that said, take a look at the bond meter. Now, the orange area chart shows us the S&P 500, which certainly has been very weak over the past couple weeks. The green line shows us the short-term bond yields. and essentially with the difference between the short-term bond yields, the 1 to the 2 year, the 2 to the 5, etc. And that is moving higher again as there's more fear out there. Traders tend to flock towards the shorter term bonds. Notice the medium and longer term bonds, the blue line and the red lines, are really starting to contract towards one another. Now, we don't know exactly what this means, but it certainly looks like there's a much greater yield, at least on the shorter term bonds, relatively speaking. And I don't think that's a natural occurrence within fixed income markets, and certainly suggests that maybe trouble is in the future. Now, taking a look, and remember again, the S&P 500 VIX did not move up as much as the NASDAQ 100 VIX. Now, what's the difference between the two? The NASDAQ is primarily made up of technology companies, healthcare companies, and the 100 is a very narrow index. So one or two stocks moving down could certainly influence that overall index. The S&P 500 is made up of technology and healthcare, but many other sectors as well, and it's a lot more broad-based. Well, left-hand chart over here, we see it's a relative strength of the individual sectors. And the number one top performing sector is the 10-year U.S. Treasury Index. Naturally speaking, we would expect higher interest rates to drive these indices higher. Number two, the CBOE, Market Volatility Index. Well, that's also natural. We've seen the VIX go up quite a bit as well. Number three is the Gemini Bitcoin Auction Index. Now, at the bottom end is technology. That's a NASDAQ 100 technology sector. The Select Spider Trust Technology ETF as well. The NASDAQ Computer Technology. And then we have a NASDAQ Telecommunications. Literally the four weakest sectors as far as the relative strength is concerned on the RSI, or I should say on the S&P 500, and this follows all S&P 500, the weakest sector is now technology. The last time we looked at this, the weakest sector were gold stocks and gold and silver and mining stocks. These technology stocks have actually underperformed gold, which is not doing well either, because again, higher interest rates, the dollar tends to go up, and as a result, gold tends to go down. On the right-hand side, we see each index within its own respective 52-week range. The 10-year Treasury Index is in a 90%, a little bit above the 90 percentile of its 52-week range. It's right near the high. Number two, Utility Index. Well, traders tend to buy utility stocks as a defensive measure when stock markets go down. The weakest sectors that are closest to its 52-week low, well, the Gold Miners Index, Gold and Silver Index, telecommunications. So what does this tell us? That immediately the move moving lower, the move in the stocks going lower, that has really hurt the technology stocks. But the longer term trend, which I think is more accurately reflected by the 52-week ranges on the right hand side, that's still gold, gold and silver. So, you know, while the technology stocks are weak, it's not, I would say it's not as much of a concrete trend, maybe not yet. But it's very interesting to see that, okay, we know over the long term gold is very weak and the bond market's very strong, but the newcomer to this game of moving lower is the technology indexes, the technology sector, the NASDAQ sector, trust, etc. So that's certainly very interesting to see. Now, finally, and this is something that, you know, I've just started to look at myself. I don't know yet what we conclude from this, but I think it was very interesting to take a look, and maybe somebody has some further insight. The red line shows us the non-farm payrolls. Now, this is these lines are jagged because they're updated on a monthly basis, whereas the purple line that's updated on a daily basis are the number of Indeed job postings, and that has steadily moved to the downside. And you'll notice a pretty interesting inverse or opposite correlation. As non-farm payrolls go up, Indeed job postings go down. Now, I think it's important to recognize that I would classify the non-farm payrolls as a lagging indicator. Of course, it reports how many jobs are created over the past month. The Indeed job postings is a lot more timely. It's updated every day, and it shows us what's happening today, what's happening tomorrow. So that's one thing. Should we, you know, infer that the Indeed job postings, as it goes down, there's less jobs out there, and that is the result of non-farm payrolls moving higher, meaning non-farm payroll shows us how many new jobs are created in obviously the non-farm sector, and that is then reflected to the Indeed job postings, that maybe every time a job is filled, that's one less job that's out there. Why aren't more jobs being created brand new, which would cause this purple line, the Indeed line, to kind of flatten out? But at least for the time being, it really does look like as non-farm payrolls go up, Indeed job postings go down. Now you'll see the latest tick over here, we're actually starting to move back to the upside. What does that mean? If the number of Indeed job postings is going up, does that mean that there's new companies out there, or there's more hirings out there, or there's some sort of investment? That would lead me to believe that maybe the economy is maybe ticking back to the upside. You know, employers are hiring more, they feel more confident, and they're going to expand their capital expenditures, more employees, better salaries. Or is the Indeed job postings moving up, is that better reflecting the fact that maybe there's just not as many people applying for these jobs, that maybe there's more people that are resigning or being laid off, or whatever it may be, and as a result that line's going up? But we have another month or so until the next non-farm payrolls will be released. We'll keep an eye on this. I'm very interested to see, first of all, how do the Indeed job postings, how does that progress over the next 3 weeks or so? And if this continues to tick up, will the non-farm payrolls also reverse course? So, very interesting food for thought. I thought I'd share that with you. We hope this has been helpful, and we look forward to seeing you back soon.